What's going on, you guys? Welcome to another video, and today we're gonna be talking about basically an introduction to the stock market. So, Kelvin, whether or not, let's get started. We headed into Apple. It's worth 2.9 trillion, and I'm showing you guys this because when you first look at a stock, you want to look at the market cap, and 2.9 trillion is the market cap. And that's telling me that a lot of people is heavily invested in this stock, and there's a lot of money flowing in and out. If I want to share Apple, a stock is a share of a company. So if a person has money and they're gonna be able to buy a share of a stock, they basically a shareholder of a company. So if I want one share of Apple right now at the current price, and it's currently at 186, I'm gonna have to buy one share, then boom, I got one share of Apple. So what is a stock? It's ownership of a company. Traded, and you can buy and sell in exchange, New York Stock Exchange, Dow Jones, or NASDAQ. And these right here are just indexes. What type of stocks exist? Energy stocks, materials, industrials, consumer discretionary, consumer staples, real estate, healthcare, financials, information technology, and telecommunication. Go back to the market capital. The different types of market caps. We got the mega cap, which is over 300 billion. We got a large cap that's over 10 billion. And a mid cap, 2 and 10 billion. And a small cap, that's 300 million and 2 billion. And a micro cap, which is 50 to 300 million. And a nano cap, which is below 50 million. So guys, basically this slide is important. Y'all make sure y'all taking y'all notes. Because with the market cap, that's what I said before you looking at stock, you want to look at the market capital, because this is going to tell you if it's going to move or not, if it has a lot of volume. So the mega cap is going to move faster than a stock that's nano cap. A nano cap is going to be like a penny stock. A penny stock that barely move. It's like 0.000000000000000000001 cent. And the mega cap is probably like $2,000 or not even $2,000. It could be 189 like Apple. Apple is a mega cap. Apple got 2.9 trillion. It's over 300 billion. So those stocks like Apple, Nvidia, Tesla, those stocks move faster than a nano cap. And you want to put your money in somewhere that's going to move. Because if it doesn't move, then your money won't move. Types of stock. Different types of market capital. We got Dow Jones. That's the OG Bobby Johnson of the stocks. Basically, you look at Dow Jones, you basically seeing how your individual stocks are doing. NASDAQ 100, the second big guy, is the tech stock. So you look at the NASDAQ 100, it's going to tell you how all the individual stocks are doing for the technology stocks. Boom, the S&P 500. Basically, S&P 500 got some big capital in that one too. And then you got Bitcoin. That's where you want to look at how your individual cryptos are doing. How your Doge, how your Ethereum, your Solana. Bitcoin is the mega cap for the cryptos. The New York Stock Exchange, that's another index. Guys, all of these right here on the screen are indexes for the overall market to show you how your little bitty stocks are doing. Why trade and buy sell stocks? Beat inflation. Inflation right now, oh my gosh, prices are hard. I go to the gas station, it's about $3.50 for gas. Oh my gosh, fruit snacks cost about $7. Man, that car, I gotta get a new Stolo, it's about 20 racks. You gotta beat inflation somehow. Boom, put your money in stocks. Start saving some of the rest of your capital. It's a way to grow your wealth. Earn a second income. Make money trading for a living at home. Generational wealth. They don't teach us. They don't teach us about that. They don't want to teach us about the generational wealth, man. Especially, they don't want to teach us about the generational wealth. You gotta do things like this to get the generational wealth. This is the way. Build capital for larger investments. Oh yeah, you always wanted to start that e-commerce website. Whoa, how do I fund it? How am I going to buy the ads? How am I going to market? How am I going to invest in people to help me? Stocks is the way, guys. Stocks is a good way to build capital, beat inflation, and start getting some passive income overnight. How to buy a stock. Buy a stock through a broker, and then the broker will give you order through an exchange. Robinhood, TradingView, Fidelity, TD Ameritrade, JP Morgan Chase. All of these brokers, guys. There's lots of them. You just gotta use the one that fits for you. For beginner level, I'd use Robinhood. It teaches you how to in and out to the stocks and how to start investing. It even gives you a beginner's guide that you can read, and it explains to you what you're doing. So Robinhood is very the entry level way of trading, and you can start options on there. You can start selling stocks. You can start with cryptos. You can even build a Roth IRA. You can even build a savings account on there. If I was beginner, I would use Robinhood. But hey, if you're a little more experienced, use TD Ameritrade. You gotta gradually progress to these different brokers. They got different access to different things. How to profit from a stock. Buy low, sell high. And that's number one. That's the bull move, you know. Good, headed to the moon. Ooh, I call it that soldier. We call that the soldier way. You know, buy low, you sell high. That's number one. Number two, you buy high and you sell higher. How to calculate your profits. You calculate your profits with the number of shares you bought times the difference between where you bought and where you selling the stock at the current price. That equals the gain and the loss. So for example, if Apple, I buy one share at 186, and I'm planning to sell Apple at 190, and I'm only gonna buy one share of it. So Apple moved from 186 to 190. I'm gonna make $4 for every share that I have, because that's the difference between where I buy and where I'm selling. It's the same way you go to the grocery store. You want to get 10 apples for a bundle of $5. But them apples tomorrow, overnight, they done rose the price up. Them 10 apples now cost $10. So now every apple you got, they went up $5. So that's 10, because the 10 apples you had, times the value that it went up. The difference between it used to be $5 and it went up to $10, which is 5. So 10 times 5 is 50. So I done made $50 because the value of my apples went up overnight. Risk management. Make sure y'all pay attention to this. Matter of fact, pause the video, go run and get your notebook, your pen, get some water too with your dehydrated. 50% win rate. 1 to 2 risk reward ratio. Jeff loses 50% of his trades, and he wins 50% of them. So every trade he gets into, he risks half of his account on. Jeff ain't gonna be in this game for a long run, because you see, guys, Jeff loses the first one, and then by the time the second one comes, he loses again. He's off. He's out. He's out. He's done. He's eliminated. Game over. He can't trade again. 50%, he risking half his account. So he lost 2 times. He's done. Pack him up, coach. Get out the game. But then we got Sally. She risked 1% of her trade. So boom, she loses her first trade. She trades again. She loses her second one. She's still in there. She only risking 1%. And boom, her third trade, she only risked 1 more percent. She's still in the game. She can risk more. She can't. She could risk more, but she's not. She's only risking 1% of her trade. Boom. The next trade she goes into, she takes a win. So boom, it takes over them 3 losses that she just had. Meanwhile, Jeff done lost 50% of his account off 2 trades. Lowering your risk is the way you stay in this game for a long time. If you stay having a low risk and a high reward, you'll be able to trade more and more over your time, and then you're able to have more wins than losses, and you're able to have more gains than losses. Risk management, guys. Make sure that you at least knowing what you risking in the trade and you keeping it minimum. Compared to how much capital is in your account, you want to consider what you risking in the trade. Common trading terminologies. We got the long, meaning you going to the moon, that means you expecting the price to rise. And you going short means you meaning that the price is finna drop. The market's finna crash. It means sell. Long means buy, short means sell. What is long and short? Trade of price direction. Long equals profit if the price goes up. Short means the price goes down. Bid and ask. The bid, price you can sell. Ask is the price you can buy. The different types of orders that you can put. You got the market order. Whenever you buy and sell on a broker, that means the market will take your price at the current price where the market is at. The limit order is basically where you would have to, you want to request a certain price that you want to put in, and you have to wait for the market to be at that certain price that you want it to be, that you're trying to request it to be at. And then you got the stop loss, meaning where you can use to lower your risk. If the price hits your stop loss, then you exit the trade. So if the price goes against you, that way you don't take heavy losses. It hits your stop loss, you out. You done for the day. That means you don't have to see your account blow up right in front of you. It can save you from risky situations. Market order. Enter the market now. The pros is you know for sure you'll get in the trade. The cons is you pay a premium depending on your broker. Limit order. Enter only if the market comes to you in your desired price. It's like a pullback. You can use it as a strategy. You know, you wait for the market to come to you. The pros is enter at a lower price. The con is you might miss the move. You might miss the breakout because they never hit your limit order. You trade against the momentum. Stop order. Enter only if the price moves in your favor. A breakout. The pro is enter trades with momentum. The con is you might be a false breakout. And guys, we all get hit with false breakouts. We cannot avoid a false breakout. False breakouts happen because people try to outsmart the market. They try to think what the market's going to do next. And then boom, a false breakout happens and they get humbled. You can't avoid a false breakout, but you can have your risk at the lowest possible and be able to lose amount that you put in the trade. Stop loss order. Exit the trade if it goes against you. The pros is you cut your losses. The cons is the market reverse pullback in your direction. Technical analysis. This is one important topic right here. This is what gonna get you the bread and the butter right here. The bread and butter, no gunner. Technical analysis consists of trends, support and resistance, area value, buying pressure and selling pressure, entry triggers, volume, and market patterns. All these are important. These gonna get you your bread and your butter in the market. These are gonna get you your profits in the market. There's no technical analysis, not having to do any research on a company or having to know any fundamental news. So first thing first, make sure y'all paying attention. The bullish trend. This guy riding the bull, expecting the price to go up. As you see right here, this is Moderna. You see higher lows right here as it's going higher. And then boom, you see pullbacks. This is a healthy bullish trend, a bullish uptrend. You can call this an uptrend right here. And boom, as you look at the bottom picture right here, this is a downtrend. Price is dropping, price is crashing. So you don't want to be buying in a downtrend. You want to be with the trend. The trend is your friend, and you ride to the end until it reverses. So lower highs and lower lows. So you see it's high right here, boom. It's getting lower lows, lower lows. It goes high again, boom, lower lows, lower lows, lower lows. The bears are sellers, and they are in control at the time. This can be a hot chocolate, my boy. This can get you out the hood. And I'm not talking about rapping or playing basketball. A candlestick. Y'all paying attention? So a candlestick consists of a solid part, the body, and two thinner lines, which are called candle wicks or candle shadows. As y'all see in this diagram right here on the left, you got a high of the range, which is at the top, and then you got a low of the range, which is at the bottom. And then at the right above the high of the range, you got the price at the close. And then you got the price of where it opens. And this right here is a bullish candlestick. Because you see as the price as it opens at the bottom and then it closes at the top. So you want to pay attention when you see a candlestick. You want to see where it opens and then where it closes. Depending on that, it will tell you where price, the direction the price is going. So if it opens at the bottom and closes at the top, and it keeps opening at the bottom, close to the top, well, you see a pattern there that it's building stairs. And that means that price is projecting higher. Same thing on the right. Let's go to the opposite side. See, you see the high of the range, and you see the low of the candlestick. And you see the price open at the top. But then price closed at the bottom. So the body of the wick is at the bottom and it's red. Well, this is telling me that if it opened at the top and it closing at the bottom, and then another one opened at the top, it closing at the bottom, it's a pattern of stuff going down the stairs. So price is falling, guys. And patterns of this and momentum going down, sellers are in control. You just knowing these candlesticks and see the direction of where these candlesticks are going will tell you if you should be buying or selling and what buyers or sellers are doing. And you basically, the candlesticks are color coded to show the direction of price moves. A green candlestick represents rising prices, whereas red candlestick shows that price fell during a time period. But y'all want to be careful because depending on where the candlesticks are opening and closing will tell you the direction and the momentum. That's because don't always focus on the color of the candlestick. The color of the candlestick can only show you price of where it opens and closes. But patterns of where the candlesticks are on the charts and mixed together, it can tell you the momentum of where it's headed and projected. Candlestick anatomy. Hope y'all paying attention. The length of the wicks shows how much the price has moved up and down in a time frame. The body on the candlestick shows the difference between the opening and closing prices in a time frame. How to tell if candlestick is bullish or bearish. So first thing first, we got a gray stone doji. Price is at a high price right here, and then we got a low price right here. And then it closes at the bottom. This right here is a bearish candlestick. That's because it had a high and a low, but look at the body. Every time you look at a candlestick, you want to pay attention to the body. The body closed at the bottom. So the bulls try to push this body to the top, but the bears was so strong, it ended up closing to the bottom. So this is what this candlestick is telling me. The gray stone doji. And it says gray stone, meaning like it's dead. It's R.I.P. Like, you know what I'm saying? It ain't Jesus, he rose from the dead. It's dead, it's done. Long-legged doji. Long-legged doji right here. We got a high price at the top, and we got a low price at the bottom. And then it just ended up opening and closing right in the middle. They broke even. Like, it's a tie. It's just right in the middle. So this is telling me that the buyers and the sellers, it's a tie. They had a tug of war, but they couldn't figure out which way to basically end up. So this right here, it means indecision. It means that either buyers can step in or sellers can take control based off the next candlestick. But this right here means indecision in the market. So you want to wait on the next move to see if it'll be either bearish, meaning the price will go down, or bullish. Y'all start using them terminologies. Now, do we like the Dragonfly Doji, man? This is what y'all want to see if y'all want to buy. For my buyers, the people that go to the moon, the bullish people, this is a good one. So you see price open high. And then it closed right here. And then we got the low price. So basically just telling me right here that the bears try to push the price down. But the bulls were so strong and they was buying. They ended up closing the price to the highest. So that means that bulls are in control because the way it closed at the highest. You want to pay attention to where the body closes and it opens. And now the strength of a bullish and bearish candlesticks on here on the right. The most bullish on the top. Boom. It opened at the bottom and it closed at the top. You see all body right here. You don't see no wick. That's a very bullish engulfing pattern right here. You see buyers are in control. And the bottom of that, you see price open at the top and it closed at the bottom. And that's a bearish move because if it opens at the top and it closes at the bottom, it's just going down. The movement from this to here is down. So price is going down. So we see right here, this is called a hammer candlestick right here. This is what you want to see if you want to buy. So price opened at the bottom and then closed at the top. You see where this body is though, it's showing where the price's direction is going. The price ended up closing at the highest, so the bulls are in control. And this one right here is representing that the bears try to push the price down and the bulls try to bring it up, but the bulls ended up just leaving it in the middle. But bears try to bring it all the way down, so the bull won the fight barely. And this one right here is showing indecision, like we see the long-legged doji. So either the bulls or the bears can take control. And this right here, as it goes more to the right, this is least bullish because where the body ends up closing on the wick. And the wick is basically this stick right here. It's that stick where you see the body stands on, because the stick is basically your vertebrae. And then you got your body. So if the body's on the bottom of the vertebrae, then it's most likely least bullish. And then you got some pretty bearish / more bullish candlesticks where the wick is at the bottom and then you got the body at the top. But it's red. That's telling me that buyers took this bearish candlestick all the way to the top because the bears try to push the price down right here. But buyers stepped in, and ended up closing it at the top. Same thing with this one. This is a bullish candlestick, but it's red. So that's why I be telling y'all, pay attention. Don't always pay attention to the candle, the color of the candlestick. You want to pay attention to where it opens and closes and where the body is compared to the wick. Because you think this is a bearish candlestick right here because it's red, but price is all the way at the top. The body is all the way at the top. And basically, you can tell it's a bullish candlestick because the bears try to short this right here all the way to the bottom right here, but buyers stepped in and pushed the price all the way to the top to end up closing at the highest of the wick. And the wick, basically, it tells you that there's a highest price and there's a lowest price. And there's a price that's in the middle. And it can be all of those for the day. It can be a high for the day, or it can be a low for the day, or whatever time frame it is, for the minute, or for the 15 minute, or for the 1 hour. Whatever time frame it is, that's all where price was at from the high and the low. That's all a candlestick is telling you. So it got a high of the range and it got a low of the range. That means price was all over here, but depending on that time frame the person was on. Candlestick body relative to the wick. You got a high close, and then, well, you got a high and then a close. So where candlestick opens, and then the candlestick at its lowest part right here. During a strong trend or reversal, the candlestick bodies are often significantly longer than the wick or closer near the high. Example of a hammer, that's a bullish candlestick, a bullish engulfing, a dragonfly doji. This right here will be a hammer because price opened up here and ended up closing at its highest. And you see at the lowest right here, the price was down there, but it didn't stay down there. It closed at the highest. Same thing with this one right here. Price opened at this highest and it closed down here, but it didn't end up closing where the lowest was on the wick. And then we got the shooting star. It's like a bearish candlestick right here. When the trend slows down or reverses, the wick becomes longer and compared to the candlestick bodies near the low. So you see, price was high, but it didn't stay there for too long. And this is what this wick is telling you. Price was there, but it didn't stay there too long. Either somebody took over and ended up pushing it higher or pushing it lower. So you see, price was up here at the highest. But boom, the bears were so strong in their control, it ended up closing at the lowest. So it opened down here, and then it ended up closing down here. They didn't have enough strength to push the price up. The engulfing. Engulfing means to pass by the low or high of the previous candlestick, indicating a trend reversal. If the size of the candlestick bodies increases over a period, then the price trend accelerates. If the market suddenly shifts from the long rising candlestick, it indicates a sudden change in the trend and bears are in control. So you see a bullish engulfing, price is dropping, price is dropping, price is dropping. Boom. A bullish candlestick that shoots it up. And that's engulfing because this candlestick just took over these three candlesticks that just pushed the price down. So this one candlestick can show that there's heavy buyers momentum stepping in. Even though sellers are trying to push the price down, the buyers are fighting and they're not letting that happen, basically. They can push the price down, but it won't push it down to a certain support level, and then it'll end up bouncing off of it and going up higher. So a bullish candlestick, it opens at the bottom and then it closes at high. A bearish candlestick, the candlestick opens above the previous close and then it ends up closing below the candlesticks open at the lowest. 3 inside up. So boom, price is dropping down. Then boom, you see this big candlestick that look like price is gonna go up. But then price goes down lower and then it starts going up higher. This is a reversal pattern. This is a sign that you want to look for when market is going down and then bears are in control and buyers are probably trying to step in for the day. The second bar is smaller, indicating a pause or an end, and the final bar shows change in momentum. And every day you see a market, it should either be a high and a low. So the low was you start off with the price dropping, and then boom, you'll start seeing some type of pause where buyers step in, but then it's still like a indecision candlestick where, let me show you how indecision candlestick, the long-legged doji right here. You'll see a candlestick like this at the bottom of that reversal pattern because you don't know what's going to step in, either buyers or sellers. Either buyers can come in and push the price up or sellers can push the price down, and this will be right there at the bottom of that. It'll be right here replacing this candlestick, and then buyers can step in. So a long-legged doji can be a good reversal pattern market candlestick. Corrections, aka pullback. So basically a correction is a pullback. You see the price going up and you're going to have to wait for a dip. A dip is basically where you want to look for buying opportunities going to your support levels. So boom, price going up, then you see these red candlesticks. And then boom, price goes up, and then you see these red candlesticks. Then price goes up, and then boom, you see you have another support level. Boom, price goes up, you have a support level. So price breaks out of your support That means that sellers are trying to come in. They break down your support level. Say the price went down all the way down here instead of going up. That means your support level has broken. Short price movements against the current trend direction and the uptrend corrections, aka pullback, is when price falls. Price does not move in a straight line. It moves in a fluctuation in one direction during a trend, but consistently moves up and down in price waves. So when people look at stocks, they think that stocks go straight up in a line. Well, it doesn't. It moves in waves, and then it fluctuates up and down. So you want to wait for pullbacks for buying opportunities. Chart patterns. You see a downtrend, and then after a downtrend, you start seeing a range. And this one I like to call the double bottom. And then you see a range, you hit your support level, and then boom, you have a resistance right here, and then it starts breaking out of resistance, and then the uptrend happens. And then the double bottom pattern right here, you see the downtrend, and then it hits the bottom. And then boom, after it hits the bottom, price goes up, and then the price broke out the resistance, but it couldn't break out of resistance. The buyers weren't strong enough, so the bears pushed the price back down to your support level. Then boom, at the support level, hits the second time, because it's called a double bottom. After it hits the second time, it breaks out. And this chart pattern, knowing this chart pattern right here will make you plenty of profits in the market. See right here again. You see, price is going down. Boom, it hits your support level. Then price goes up. Then they weren't strong enough to break it out of resistance. So the bears push the price back down. Buyers still try to come in, push it out resistance. Bears were not having it. Boy, they hit them with an RKO, push the price back down. Then boom, second time, not it. Second time's not a charm. Third time's the charm. Boom. Buyers step in third time, they able to break resistance. Now price is projected upwards. They headed towards the moon. Just knowing this simple chart pattern right here, they call the double bottom pattern, will keep you in the money, keep you profiting. So you just gotta pay attention to how these candlesticks are moving, and most importantly, you want to start seeing them, what they do together as they move. You want to start paying attention to the rhythm of where they're moving. Entry trigger, candlestick patterns. This is how you time better entries. You want to get better with candlestick patterns. Shooting stars, hammer, these are bullish candlesticks. Had to calculate your risk. Risk not more than 1% of your trading capital. Have a proper risk management by cutting losses short if the trade goes against you. Start using stop losses. Be able to cut your losses quickly. Don't wait too late. If you know the market's starting to reverse, don't wait till it's already broke past your support levels the third time to end up exiting the trade. End up exiting that trade when it broke down your third or second support level. No, always have an exit whenever you enter a trade. It's easy entering a trade. All you gotta do is hit the buy button. The hardest thing is exiting a trade, even if it's against you. You want to hold them losses, but end up losing the whole thing. Trading methods. This is different ways you can trade. They got day trading. They got swing trading. And then there's position trading. Day trading is below the 1 hour time frame. So you usually trade between the 1 minute time frame where candlesticks pop up every 1 minute. And then you got the 5 minute time frame that candlesticks pop up every 5 minutes. And it captures the intraday volatility. Pros, you can profit on most months. The cons is a lot of psychology, stressful, requires a lot of screen time, high opportunity costs. So basically you gotta pay attention to the markets. You can't really keep your eye off of it too much, because a minute you might be up, then another second you might be down. And you got to be able to control your mind, your emotions. You can't rush the market. You can't be impatient. And you can't just be greedy. You can't. You have to be able to have a quick decision-making skills. These are traders that make quick decisions. They're able to make quick press buttons, be able to quick press in seconds to buy, boom, quick decisions to sell. You know what I'm saying? And they done. You gotta be able to control all of that. You gotta be able to control your risk, be able to control your profits. You gotta be able to control the emotions. Even when you're down, are you gonna sell, or are you gonna hold it out until the market reverses? Are you gonna be able to read these candlesticks and make a good decision to enter, and then already have an exit plan? A swing trader, it's between the 1 hour and the daily time frame. So this people, they trade between where a candlestick grows every 1 hour, and then or the daily time frame, which is a day from 8:30 to 3, and they capture one move in the market. All they need is one move. They're looking for a big swing. They're looking for a big price drop, and then boom, potential breakout. The pros are it's less stressful and don't need as much screen time. So once they see a big drop in the market for the day, and then they start seeing buyers stepping in, and then they get confirmation, they already buy, they're in there. So they wait till buyers push that price all the way till they did to the highest where they can, and then they exit. The cons is the market can make drastic moves overnight. So these people swing, they see a big price drop during the day, and then they hold it overnight, and then boom, price could either, if it was a bearish in a downtrend, price could drop even lower. So them people lost money overnight because they bought before the day, and the pre-market they could be down. So it can be a risky way of trading because you're holding your position overnight, and the stock market moves in a pre-market and after hours. So drastic moves can happen depending on the economy and the company, the stock, and a lot of things. It can be anything. Position trading. These people trade between a 1 hour time frame and a weekly. So they wait for a candlestick to grow every 1 hour, or for a candlestick to grow every week. And they buy and hold until the trend reverses or shows weakness, either for the months or the years. And this right here, the pros, is less amount of screen time, capitalize off trends, and huge potential reward. So these people, they hold a position. So they hold a current price until that price is way more than it is. So they might hold it for months. They might hold it for weeks. They might hold it for years until that position is way more than what they bought it. Then they'll exit that position. And the con of this, it requires patience and potential overnight losses. They might endure more losses and losses and losses and losses, but them people are still going to hold that position until they are in the money and profiting. And this can be risky because they could never be back in the money. They can never be in the green. They'll never be back in the profit until they have enough patience to be in that position, and that position is way more valuable than what it was. And that's all for today, guys. I hope y'all learned something in this video, and y'all can comment down if y'all had something that y'all had questions on, or y'all really was like, oh my gosh, I didn't know that. Drop it down in the chat, and make sure y'all share with your friends. Make sure you like, of course, you like this video so other people can share the video and see it, and then they can get the knowledge. Most importantly, hope y'all took it notes. Y'all have a good one.
Living in a oasis, configuring databases, so I gotta lay back, blowing
If
you can't perceive it, don't repeat monopolies that usually perceive what we see. You said it's free, why the hell are they taxing me? At the end of the day, remember all the levels left. They say dark shades come around death, but trust me, I'll be by your side like I never left.